So I've mentioned the basics of the candlestick chart and what makes up one candlestick. You've got a body which reveals where the security opened and closed, and that will be either green or red, or white or black, depending on whether the security closes higher or lower than it opens. And then you've got the wick, which can be below or above the body, and that shows the lowest or highest price that the security traded at during the trading period. And that trading period can be anything from a minute to 2 hours to a daily chart or a weekly chart or whatever. The wick can also be referred to as an upper or lower shadow, depending on whether it's above or below the body. So once you know the candlestick formation, the next step is to identify the basic candlestick patterns and their names. So these basic candlestick patterns can be market neutral, and they're not necessarily used in the trading decision process, but they are the building blocks for the more advanced patterns. So one of the most well-known and easiest to spot candlestick patterns is the doji, which typically has a thin horizontal line for a body indicating that the open is equal to the close. Usually the top and bottom shadows will also be fairly long to show that price moved in both directions over the period. This reflects indecision between buyers and sellers as price spiked up and down but wound up ending right where it started. Because it represents indecision, this type of formation is usually regarded as market neutral. However, it can also be interpreted as a weak reversal signal. If formed at the bottom of a downtrend, a doji can signal indecision and therefore can suggest that the downtrend could be coming to an end. And the reverse is true for a doji in an uptrend. This is a weak signal, so traders will typically need confirmation from another candle or another indicator before jumping in on any trades on this one. A rule of thumb is to wait for the next candle to close above the high or below the low of the doji before making any next trade decision. Another potential reversal candlestick signal is the spinning top, which contains a small body with relatively long top and bottom shadows. As a result, it looks just like a spinning top. Unlike the doji, the spinning top will have a slightly larger body and be regarded as mildly bullish if the body is green and bearish if the candle is red. Again, this is a candle that suggests hesitation and uncertainty, indecision between buyers and sellers. Marubozus are another basic type of candlestick pattern that provide weak signals of whether to go long or to go short. Unlike dojis and spinning tops, a marubozu has a large body with very small or no shadow at all. These are typically considered continuation patterns as they indicate that one side of the market, either the buyers or sellers, are in control. A bullish marubozu will be green or white and have its open price equal to the low and the close price equal to the high. This indicates that buyers were fully in control over the period, the market closed at its high, and this is a very bullish indication. A bearish marubozu will be red or black and have its open price equal to the high and the close equal to the low. This indicates that sellers were fully in control during the trading period, and this is a bearish indication. So you can clearly see how a marubozu can be a good bullish or bearish indication. However, one marubozu candle on its own is generally not enough to make a trading decision. So these are weak candlestick patterns that are best used in combination with more advanced patterns or indicators.